My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job, not just to entertain, but to explain. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Hey, look, we can say it's about time. We can conclude, frankly, that we deserve to go down after this long run, right? Or we can simply admit that things got way too frothy. Too many stocks were going up on very little news or no news at all. And now those momentum buyers are deservedly getting their heads handed to them, and they're leaving. Look, I know that's a brutal conclusion, right? But it was a brutal day with Dow tumbling 524 points, S&P plunging 1.37%, NASDAQ plummeting 1.8%. Look, the best thing that can be said about today, it was much worse a half hour before the close of the session. Yes, the market did run into the bell. How deep will the sell-off be? I think we can have a few more percent or maybe even more with some stocks, especially tech, because some of these have been running nonstop since November. Let's understand, though, this sell-off has two components. There's the precipitating event, which happened to be an overheated consumer price index number that was announced at 8:30 this morning. And then there's the reaction to the event, where shareholders who thought they couldn't lose found out they could, and they cut and they ran. Let's talk about the precipitating event first. This morning we learned that CPI did have a blip up, mostly thanks to the cost of rent. It's funny, rent had actually started to cool, but we got a big reversal, and it went up enough to cause a serious disappointment in the aggregate number. Hey, look, that said, I never like to look at the aggregate numbers. They don't tell you enough. In this case, when you see rent soar, you have to ask yourself, has something changed? Why did the trajectory of rent shift? It could be because maybe the sudden influx of immigrants, legal and illegal, who need to be housed without a lot of sensitivity to pricing because the government's doing the renting. A big group of price-insensitive renters can jack up the whole darn category, and that is what I think happened here today. I know you can't asterisk it and say, if it weren't for rent, we would have been in good shape, because the number's not what anyone wants to see, and shelter is a key component for everyone. I am of two minds, though. The first is, thank heavens Jay Powell didn't start cutting rates, because this number would have made him look like an idiot. But second, it's time to recognize that the economy still has a full head of steam, and if Powell hadn't committed to a course of eventually cutting rates, there'd be plenty of people out there buzzing right now that he should be raising rates, not lowering them, raising rates. Now, how about the second source of today's pain? Those who found themselves on the wrong side of the trade. First, it's not one group. It's an agglomeration of institutions and individuals that have misjudged this moment. These people, for lack of a better term, were just plain wrong about both their conclusions and their investing style. That is, if they have an investing style. A large assemblage believed that we were set up for a May rate cut, something I've repeatedly told you is insane. Now, totally beyond the realm of possibility, because the economy's way too strong. We got that rent number and the bad CPI. A lot of these May believers were the same clowns who thought we were going to get a cut in March. They tend not to do their own homework. They listen to what some Fed governors might say. They look at the yield curve, and then they declare themselves experts and say, you know what, we're going to have aggressive rate cuts. Now, if they did a stitch of homework, they'd realize there's no real reason for the Fed to accelerate its rate cuts or actually do anything at all. We have very low unemployment, and we haven't vanquished inflation. The bozos who keep expecting big cuts may sound professional, but I think they are rank amateurs who don't know economics or history. Second wrong cohort? Those who believe that because it's an election year, and election years are always supposed to be good, the market really can't go off the rails. That's fine when the year begins, but the average were up 4 to 6% coming into today, and the election cycle is a defense. That's not going to protect you. It's not a lovey blanket full of, it's a lovey blanket full of holes. What are you supposed to do with this thesis tomorrow? Buy because it's an election year? It gives you no protection whatsoever, especially because the election seems, I would say, a tad on the aberrant side. Third group that's off sides is the shareholders who stayed at the party too long after drinking Sterno from a trash can. Yesterday, I commented that when I saw the stock of ARM Holdings, the amazing semiconductor company, double intraday from where it was just last week. And by the way, it's a large cap company. I knew that things had just gotten out of control. That's when I put it on a froth alert. That meant individuals, perhaps searching for the next NVIDIA, used market orders to buy the stock, partying like it's 1999. For those of you who don't remember that era, all I can say is that there was a belief that you couldn't lose when you bought a stock. That meant it didn't matter what price you paid for the stock. So you just put in a market order and accepted the report. That was when things started to get out of control. Right now, very little ARM stock is available for sale. The underwriters only sold a little sliver of it on the deal. The vast majority is still owned by SoftBank and is under lockup. So when you use market orders, let's just say you're an idiot. You may have paid as much as $164 for ARM, which is nuts, given now the stock's pushed below to $120. I think it's still too high. And I say that as someone who loves the company, loves the management, loves the business, and tried to get you in the stock several times in the 50s and 60s. Price does matter. ARM is an extreme example of froth in the market, but there are plenty of tech stocks that have rallied like crazy, even as their businesses are, let's say, abstruse. Meanwhile, many of the recent buyers are obtuse. They have no idea what the companies do. These people make for terrible fellow shareholders. So if you own high-flying stocks, understand that your fellow travelers are now your enemy. It doesn't help, by the way, that many of these stocks are not cheap and they're vulnerable to shock, given their extended valuations. We're going to talk about some of them later in the show. So what should you do if you own stocks right now, given that so many longs were wrong about the market and will have to skedaddle? We've been sellers for the Charitable Trust, which you can follow along, of course, by joining the CNBC Investing Club, by which you do. I think it's good. And we were not tempted to buy anything today. We did a lot of looking, came close to pulling the trigger on 2 different occasions. But we decided, you know what, we might get lower prices tomorrow. We want to keep our powder dry. If you want to sell some stock here and then buy it back at lower levels, I think it's actually the right course in theory, but it's very hard to execute in practice. Today I heard someone on air say that sell-offs are gifts. Now, I never like to use that terminology because these are the kinds of gifts that the Greeks gave to the Trojans. However, I say this: the market can't advance on froth without terrible consequences. We got to drain the froth and refresh, and that's what today was, as those who don't know anything about the economy or their stocks get cashiered out of the market. They can't take the pain. When they're done selling, it'll be safe to buy. Bottom line: the market won't bottom all at once, so some stocks will bottom tomorrow. But I think this is a sell-off based on bad judgment, not bad earnings or a bad business environment. And it will be cured by the departure of those bulls who got caught off sides, who now be pulled from the lineup and sent back to the sidelines, where they can earn their 5% while they break form and do some much-needed homework. I want to go to Brian in Pennsylvania. Brian!
Hey, Jim. Thanks for taking my call.
My pleasure.
Jim, over the summer, I sold Verizon and I went into T-Mobile. Now, I've written some covered calls on T-Mobile that are now in the money and will probably get exercised on Friday. So what do you think I should do with the money? Should I go back to T-Mobile, or should I take a second look at Verizon since they're doing a little bit better now?
How about taking a breather? How about letting see what both of them can go? What happens if you get T-Mobile 155 instead of 160? How about if you get Verizon back when it yields 7%? That's what I would do. Sideline. Keep it on the sideline. Maybe we get better prices. And then you can pull the trigger, and that would be the right thing to do. Okay, let's go to Kyle in New Jersey. Kyle.
Hey, Jim. First I want to tell you, for every mean person on Twitter that has something bad to say, there's 10 guys like me that have nothing but love for you, man. You made such an impact in my life, and I love you for it.
Kyle, thank you very much. I give them pictures of my dog, Wolfie. They don't know what to do because they probably like dogs. How can I help?
I walk through my town in Ocean City, New Jersey, and I see every attractive housewife walking around in athleisure. And I look down and I see On clouds on their feet. And I wonder if On might be the next Lululemon.
First, stop looking, okay? Stop that. You're going to get in trouble. I think On is terrific. I tell you the truth, there's people betting against this company. They have not met management. They haven't spent time. It's 16% short position. And I've got to tell you, I think On is here to stay, just like you. And that's because I have an attractive non-housewife wife who has 17 pairs in my closet and has forced me to move to the hall. There. I like all Kyles from Jersey, I will tell you that much. I think today's sell-off is based on bad judgment rather than a bad business environment. And that bad judgment can only be cured once the bulls who got caught off sides are sent back to the sidelines. They shouldn't be on the playing field. Made money tonight. Shopify reported an earnings beat, but the stock fell 13%. What the heck? I'm thinking the details with the company's top brass. Then Arista Network, strong long-term performer, just like the tech stocks I just mentioned a second ago, it got hit. So are investors getting the opportunity to buy? I don't know. We have to do some work on it. And first came McDonald's report, which was disappointing. And now it's Restaurant Brands International. I'm learning more about the state of the quick service restaurant space with QSR's executive chairman fresh off the earnings. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.